You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday. It is time to hold court here on the Options Insider Radio Network and talk some options edumacation. Yes, it is time once again for Options Bootcamp. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever-exciting network upon which so many of you are binging these days. Remember, if you do like what you hear, throw some stars our way, just like AJ Grunt did this week. Gave us 5 stars and said, just very simple, very, very concise. Great show. We'll take it. Thank you. Thank you, AJ, and everyone else takes the time out there to rate and review. You know, we've been doing the show for a long time. Might not think we need reviews anymore, but new people are discovering the options world all the time. They need help, and the algorithms on all those platforms do favor new reviews. So if you do like what you hear, you are helping out by rating the show, even though it has been around for a while. So if you do like what you hear, do throw some stars our way. It helps new people continue to discover the show. Speaking of discovering the show, we're having a fun party today because today was our Pro Q&A session number 100. Hard to believe. So we just got done answering a whole bunch of questions with our buddy, Mr. Matt Amberson from ORATS, a.k.a. the Oracle of New Hampshire. He has made some guest appearances on this show as well. That was a fun time. So we thought, why not keep the party going? Usually we limit the live to the folks who are on the pro side, but today we're throwing open the floodgates to all comers. So if you're out there in the listening audience right now, you're visiting us, following us at Options on Twitter, then just click on that link. We put it out there to Twitter, onto StockTwits, and pretty much everywhere else. You folks can click on that and join us live right now to participate in a fun mail call palooza. We're not done answering questions yet because I am joined once again by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir. Are you ready for some live question answering extravaganza, sir?
Yes, I am, my friend. Let's do this thing. This sounds great.
All right, let's do it. Here we go. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, let's get to it, listeners. Let's start with some of your feedback, your views from last week on our question of the week. It was kind of an interesting one. We asked you quite simply, in these troubled times, where are you allocating the majority of your portfolio? Gave you cash, gave you crypto, gave you equities, and commodities/fixed income. Those were your 4 choices. And as we talked about on the Pro Q&A last hour, 45.6% of you chose cash. So almost half of our very option-savvy audience hanging out in cash right now, followed by 32.4% for equities, 19.1% for commodities/fixed income, and only 2.9%, a distant fourth, for crypto. Mr. Dan, I was kind of surprised by those results. Are you surprised that so much of our option-savvy audience hanging out in cash right now?
Yeah, I'll tell you, I am a little bit surprised. But I mean, to be fair, cash plus like long calls is like basically a way to hedge being out of the market. So maybe some folks are doing that.
Yes, there are many different ways and flavors you can carve up that cash, right? You can have cash, and maybe you have some out of the money puts against that. So you want to get long some positions, you can. So effectively cash secured puts. There's a lot of different ways you could carve up that cash. But yeah, a lot of people are sitting with the majority of their balances in cash right now, which again, we've had a lot of guests come through our pro Q&A recently, Dan, extolling the virtues and indeed the optionality of cash. You think about it, cash is an option at the end of the day. It gives you a chance to pull the trigger whenever you want. So there is that nice element to it out there, which makes it, I think, reassuring for a lot of people. And of course, they're getting 4.5%, maybe 5% in some accounts as well. Obviously, inflation eating into that, but that makes that cash decision a little bit easier for some folks who are on the fence. But you know what, Dan? The folks are here now. They want the much anticipated, much heralded, award-winning market taker question of the week. What you got for us, sir?
Yeah, so that's, I guess, why I was thinking about hedging, and what is the best way to hedge a long-term portfolio, and we could do a whole show on that. And in fact, we probably should at some point. But the short answer is basically you want to find a broad-based asset, basket asset like an ETF or index that most closely matches your portfolio. For some folks, that's the NASDAQ, some the S&P 500, some of the Russell, or it could be smaller ETFs, sector ETFs. And, basically what you really kind of have to do is some derivative of a collar, because just going out and buying puts is very expensive. It's prohibitively expensive unless you really pick your spots and, you get quote unquote lucky and the market goes down. But if it's a hedge, you're not really getting lucky in that case. So you always want to try and finance the cost of that put with selling something else, typically some sort of other call, often a shorter time horizon, and then manage it. But like I said, maybe that could be a show one of these days, Mark.
Yeah, I think that could be a fun one. A lot of people are facing that question right now, right? How do they hedge their very broad portfolio? And it could be an intriguing discussion for a full episode. So maybe stay tuned for a deeper dive into that in the future, listeners. Now we keep on rolling with your questions. By the way, if you're listening live, listeners, because we have opened the floodgates to all comers, if you have some questions floating around in your noggin you want to get at us here, use that live chat to do just that. Meanwhile, we have a bunch of people who've already beaten you to the punch here. Let's start out with this one. Let's go to Robert Grum. His questions are kind of grim. Actually, he has more of comments than questions, but intriguing nonetheless. Obviously, Robert probably maybe comes from a liquidity provider or some sort of professional side of the business. He wrote in to say, I listened to a part of your last podcast where you discussed the quantity of exchanges. He's going back to the episode we did, or why are there so many freaking exchanges, I believe was the title, something along those lines. He says, I will acknowledge that there may have been initial tightening of the markets, and I will certainly agree with the fragmenting of liquidity that occurs. But even worse is that all additional exchanges are simply attempts to create a place where fewer market participants can get in the way of large orders, minimizing competition. I do not understand how regulators didn't see this and allow more and more exchanges to be created. Yeah, Robert, I don't think Dan or I were very much on the more is merrier trend on that show. In fact, I think we've firmly come down on this program on there are already way too many exchanges, and adding more at this point is going from being not just de minimis in terms of a value proposition, but actually potentially dangerous when you're talking about order routing now to all of these different exchanges, all of them having to line up with the MBBO, the market traffic that is generated by all of these additional participants. Remember, it's not just trading, but it's quote traffic. These things all have to be quoted. Think about every exchange that's just listing Apple and how many calls and put series are listed on all of those, and all of the messaging traffic that has to go up with every tick of the underlying. How many different series have to be updated continuously on all those multiple venues. And that's just for Apple. Now multiply that times all of the other venues that are out there and all the other series, and the quote traffic it's hard to fathom for the average person, how much messaging traffic is going back and forth in the options world. We also have issues with just routing to these exchanges. There's all sorts of issues that go along with this, with the routing and execution, not to mention what we talked about on that show, which was, of course, the fragmentation of liquidity, which is still a huge problem, particularly for spread traders. So I don't think Dan and I were too optimistic on it. Dan, do you agree with him? He doesn't understand how regulators don't see that adding more venues is just a way to allow fewer market participants to get in the way of large orders. So he thinks the regulators should step in on it.
Yeah, I don't know. The regulators, honestly, I think they just really don't understand it, or care to understand it, or have the incentive to understand it. And so, they were the ones who got talked into this mess by, Goldman Sachs and all those guys early on. It was their brilliant idea to have multiple exchanges, which ended up not being as good for the typical trader. But hey, man, what are you going to do?
Along those lines, Robert had a follow-up question. We'll usually limit you to one, Robert, but we're nice here on the show today. We'll give you the second one, too. His second follow-up was, can you address the QCC in one of your podcasts? This is another mechanism that, in my opinion, hurts customers through fees and zero market exposure. How the SEC allows this to continue while seemingly over-regulating other aspects of the industry doesn't make sense. Again, Robert, this is kind of a in the weeds type of topic, but hey, we'll take on all comers here. So if you're not familiar with this, listeners, don't be surprised if you're newer to the world of options. The QCC, that stands for Qualified Contingent Cross. It's a type of order, usually for big block trades. I remember talking to the CEO of the ISE at the time, Gary Katz, when he was talking about this. They're the ones who put this order type through. And it's effectively allowing institutional brokers to cross orders electronically without really exposing them into the market. Now, they have to improve the market. They have to be better than the NBBO. So at least there is that protection in there. They also have to have a certain size restriction. They have to be at least for 1,000 contracts, I believe. So, yeah, anything, Robert, at the end of the day that kind of disguises liquidity like this. I mean, I'm an old school market maker. Dan's an old school market maker. So I don't think you're going to find either of us too enamored by the notion of crossing to begin with. I mean, for me, the straw that really broke the back for me on the market making side, in addition to everything else, the penny pricing, the competing with other exchanges, the payment for order flow, all these other things that really disincentivized being a market maker. On top of it, the thing that really just drove me out of the business was the notion that they used to have to, in the early days, if the broker wanted to cross an order, which of course, listeners, means the broker takes down both sides. They have a customer looking to sell a particular options contract, and either the broker themselves buys the other side of it, or they find another customer, preferably to buy the other side of it, so they get paid on both sides. So that's called a crossed order, listeners. They used to have to do that, but they had to improve the market. So if the market was $1 bid at $1.10, they couldn't just cross the options on your $1 bid. They had to do it for at least $1.01 or something along those lines. Those protections, when those finally went away and brokers could come in and they could cross orders on my bid or on my offer, they didn't have to do anything to improve the market. That's when I realized the writing was on the wall for a lot of market makers out there. And I started looking at other things, and lo and behold, the Options Insider was born. So I'm not a huge fan of any of these mechanisms that allow people to, as you put it, disguise liquidity. Dan, what are your thoughts on crossing in general then, as Robert wants to know, specifically this qualified contingent cross? Do you have any issues with it, sir?
Yeah, I mean, in practice, it ends up being kind of a conflict of interest, in my opinion. Like on the surface, supposedly maybe somebody might have the opportunity to get in there. But in practice, they really don't. And I don't know. I mean, if it trades in the middle of the market, or on the bid or the offer, I guess that's okay. But when you start cutting out liquidity providers, it really kind of hurts the whole system, I think, in my opinion. So yeah, I'm not a fan of it.
And to answer the other part of your question, Robert, the SEC did hold it up for, I believe, a couple of years. They were supposed to come out in somewhere around 2009. I don't think they finally gave it the nod until 2011. So for whatever it's worth, they dragged it out for 2 years, but they did end up ultimately approving it. So yeah, unfortunately, I don't think either of us are big fans of anything that kind of continues to disguise liquidity or move it away from the execution really on the venues that people want them to be exposed to the market at the end of the day. Anything that doesn't do that, not a huge fan. All right, let's go to Brian. He's asked this question on some other shows, but he sent it here, so I want to make sure we answer it here as well. He says, hello, options gods. Well, well, hello, Brian. I like that. Options gods. Flattery will get you everywhere, Brian. He says, is there a program or service for visualizing options pricing changes in real time? He puts in parentheses, call versus put pricing changes that can be used for market sentiment. Also, can long-only leveraged ETFs fall apart the way SVXY did? Thank you. Yeah, a couple of ways to answer this, Brian. The first part, any levered ETF, these are Frankenproducts at the end of the day. They all can fall apart. They all have nuances and devils in the details of their construction. So they all can go the way of the dodo, even the long-only ones. It's not just, inverse and other things like that you think of when you think of the high-risk levered products. These other ones can fall apart as well. So yes, we encourage everyone when they're trading in these Frankenproducts out there that to make sure you do your homework, you read the prospectus, you understand all the little nuances, all the little details. Is it a note? Is it an ETF? Can this be called away? Are there provisions like there were in some of these other products where they can kind of just decide to just shut it down? All sorts of interesting little booby traps can be lurking in that prospectus. So take some time to look into those. As for the visualizing options pricing changes in real time, you want calls versus puts. So you want to see maybe some opportunities there for conversion reversals to do synthetics, that sort of thing. That can be used for market sentiment in real time. That's an interesting one. We were just talking about this with Matt from Orats earlier. He used to do some visualization software. He still does at Orats, but he couldn't think of it. I really can't think of any that do this in real time for calls versus put. Maybe you can also look at that from a skew perspective. And if you want skew, there are a lot of platforms that will graph that. Even some brokers will do that. I know LiveVol has some pretty extensive skew charting. So if you want to see it from a skew perspective, you could see it that way. But straight just call versus put pricing changes. Dan, anything you want to add there on either of those, sir? Are you familiar with any of the good visualization software to start? Then if you have anything to add on the long-only levered ETFs falling apart, have at it.
Yeah, it's kind of two questions in one. As far as the service for visualizing option prices, real-time call versus put. I guess I'd kind of have to know exactly what you're thinking there. Like my mind just immediately goes to call versus put. We're talking put call parity, and there really is no difference except for just, noise in the market, which can be exploited if you have a big enough account and flexible enough margin. So I guess I'd need to know a little bit more where you're coming from. And yeah, man, anything can fall apart. Look at, during the, let's see, one that comes to mind is USO almost did. There was one that did fall apart right before USO almost fell apart. This is back when crude started trading negative. Anything's possible. And a lot of these ETFs, they're very nuanced, and those nuances usually don't come into play, but when they do, man, oh man, there's big money to be made or lost. And if you're not on top of it, you're more likely to be on the losing side of that.
Yeah, Brian, if you have more info on exactly what you're looking for, because I kind of read it the same way Dan does. It's kind of just a call put thing, and that's not that useful, really. And so there aren't a lot of platforms that are going to do that for you outside of what I mentioned, kind of some weird conversion reversal opportunities. But those are kind of few and far between. As Dan mentioned, you probably have some decent account size to really have to take advantage of those. So I don't know if that's not what you mean, then write into us what you mean. I think we're both a little confused about what you're looking for. But let's keep on rolling. Speaking of services and data and things, we had a question last episode from Cody. You wanted to know where you get your options data for the shows. And, as soon as the show was over, I realized I forgot to mention a bunch of the platforms that we used. On the show last time, of course, I mentioned Trade Alert and Orats. Those are two of the big ones. Those are two of the most obvious ones. Those are two of a lot of the data that we surface here on our shows. Trade Alert, obviously, for the option block, and we have Henry on. We do a lot of flow scanning with that. We just had Matt from ORATS on. Obviously, a lot of the earnings data we put out for you guys completely free. That comes from Matt and his team over there. So those are two very good ones. But I neglected to mention, first off, QuickStrike, which is, of course, the platform that we have built our entire This Week in Futures options program around here on the network. And the best part, you guys can access that one for free, at least the basic version of it, whenever you want. Just go to cmegroup.com/TWIFO, TWIFO. That allows you to do all of those basic scans we do on the show completely for free for any product that trades at CME. So you want to look at crude oil, nat gas, gold, wheat, whatever floats your boat. You can do all that at that URL. Of course, you can then upgrade if you want to check out some of the more advanced features, and there are quite a few of them. So if you like trading futures options, I encourage you to check that out. But I neglected to mention QuickStrike first off. And then also on the crypto side, we do a whole show with the folks over there at Amber Data, and they provide a lot of what we talk about with, Trade Alert and QuickStrike, but for the crypto derivative scene. So they'll take all of the flow going on in places like Deribit, and they'll crunch the skew numbers and the vol numbers, show the OI changes and everything else like that. So if you're looking for analytics and data from more of a crypto derivatives perspective, that's another great platform. Now, all of these cost money to various degrees. Like I said, the QuickStrike one, you can get a free, you can pretty much use all the basic features for free at that /TWIFO link over there at CME. The rest of them, we give you a lot of data from ORATS for free. They have more that you have to pay for. Trade Alert's a pretty beefy bundle. It's really for institutions. But you can try it if you are so inclined, as well as Amber Data. They do have free trials there as well. So you can check out all that kind of stuff. But I wanted to make sure I gave you the full gamut of a lot of the data offerings. As soon as we finished the show, I said, wait a minute. I forgot to mention a whole bunch of them out there. Dan, any other interesting options data sources that you use you want to mention here on the show?
Yeah, I mean, I like Trailer and ORATS. Honestly, for a lot of the things that we talk about on the show, I'm just using Thinkorswim, and pulling up just live option chains or charts or whatever. Vortex is interesting. What else do I use? Oh yeah. You know what else is a good one here? Hold on a second. Oh, Market Chameleon. I'm a big fan of those guys. FinViz. Yeah, I mean, there's a few things to think about there.
Vortex. I haven't played around with them. They're more like on the short interest side, right?
Yeah, they're a lot more short interest.
There you go, listeners. If you're looking for the meme stock palooza 2.0, maybe those are some of the ones you want to check out as well. If you have some platforms you like to use, maybe they're free or low cost, you want to share them with your listeners, hit us up. Let us know here, listeners. But yeah, those are some good ones. And on top of whatever your broker provides to you, listeners, obviously it should be some good tools there. And if there aren't, you should probably switch brokers. Let's go out to the live. Option God, he has a question. He says, speaking of Frankenproducts, yeah, we were just talking about Frankenproducts there for that question. He wants to know, what do you guys think about SVIX as a trading vehicle for newer options traders? SVIX. Good old SVIX. This is, of course, listeners, if you're not familiar, as he mentions, it is one of the Frankenproducts. This goes back to, I think it was Brian who was asking about the risks of these products. This is one of those ones that falls into those high-risk categories. This is an inverse VIX ETF. So obviously, VIX is known, not so much recently, but in past years, for being a product that can explode to the upside, right? So if you have a product that is inverse that, those explosions to the upside could be dangerous. Just go back, look up Volmageddon or VIXmageddon from February 2018. You could see what happened the last time VIX spiked up to 80. What happened to the previous inverse VIX product, which was XIV. Spoiler alert, it went the way of the dodo. SVIX right now trading right around 19 3/4. As for your question about what I think about as a vehicle for newer options trade, we talk about this a lot on our Volatility Views show. So listeners, if you are intrigued about these kind of products, tune into that show. We talk about a lot of the vol ETPs there. And one of the complaints I've had about SVIX for a while is that it's just not very liquid. So if you're looking at it just solely from an options perspective, if you like the underlying does decent volume. If you wanted to buy SVIX to kind of speculate on a nice little pop and VIX dropping, then that's a way you could play it. I would make it a short-term trade. I wouldn't really buy and hold a lot of SVIX. But the options side, it's still challenging. I mean, looking at it right now, the ADV has ticked up. It used to be about 700-800 contracts. It's about 1,250 now. So that's better. But it's still not much. And today, only 250 contracts have traded. I've traded around in it in the past. The markets are scary. They're very wide. So that's going to probably put you off. I have had surprisingly decent experiences, though, trading in between those markets. The market makers do seem incentivized to want to step up and fill you. So I even have gotten some butterflies off out there, which kind of surprised me. Those are 3-legged trades after all, listeners. And I was able to get some of those done. So that did surprise me. So maybe if you're intrigued and you're put off by the markets, it might be worth putting a few feelers out there, some verticals or other things that intrigue you, and just see if they meet you halfway with the spreads. But you are going to probably have to work whatever you do out there because the liquidity isn't quite there yet. Also, no weeklies, only monthlies. That's another problem. But then again, there isn't enough liquidity to support the monthlies, so I get why there aren't weeklies. So for a newer options trader, I might stay away just because there's a lot of nuanced understanding of what the underlying actually is. And then also the liquidity, you got to be a little bit adept at working your orders to get things done out there. So I don't know if I was a newcomer to the world of options and I wanted to trade some vol, obviously the mothership like VIX is probably a more intuitive thing. But even with those, there's different expiration cycles that can be a little bit confusing as well. You got to tread carefully in the world of volatility trading products. Mr. Dan, our live listener here, wants to know what we think about SVIX. What are your thoughts on SVIX, specifically as a trading vehicle for new options traders?
If you're a new option trader, stay the bleep away from it. I don't know. I mean, for just like straight trading, I never understood why there's a need for an inverse product. Like you don't know how to buy puts or short, shares of an ETF. Like I don't understand. Like it doesn't make sense why they would exist. But once they do exist, then I think the only smart way to get your hands dirty with them is to do it as some part of some sort of arbitrage play or pairs trade or something like that, where you're doing something smart, not just like, oh, I want to get short VIX, so I'll buy this goofy thing that has all these additional risks, hashtag Volmageddon. So yeah, if you're new to it, it's a silly thing to be messing around with.
Yeah, don't rush into those kind of products. Give yourself time. Stay with your Apples and your Spies and your Teslas, and maybe go from there. Let's go out here. This is just more of a comment here. I like the handle, though. Open Outcry Locals. We got a lot of market makers and professionals writing into the show this week, Dan. Even though it's a basic education show, they're writing in. Open Outcry Local says, I was in my senior year of high school in the burbs of Milwaukee, and we went to the Merck and the Board of Trade for Finance class in 1981. That was it for me. 18 years old, started as a runner the summer after graduating. I have seen it all. Oh, well, there you go, Dan. He was lured to the dark side. Yeah, Open Outcry Local. My story, I didn't grow up here, so I didn't have that experience. But my cementing fact, the catalyst that really lured me to the dark side was I was interviewed in the SPX pit when I was thinking about doing this at the job. They flew me out here from New York and they brought me into the SPX pit. And even though it was a slow day, that's why they were able to do that. Just being surrounded by that. And I said, I could do this now. Forget about all those New York desks. They want to rotate you through all these different training programs in a year doing this and a year. I said, no, I want to do this. I want to dive right into the fire. So I had a similar catharsis, catalyst moment, call you what you will, moment, Open Outcry, where the pit just spoke to me. I don't know what it was. For certain crazies like us, I guess that was the case. Dan, what was your moment? What was your moment of luring you to the dark side for floor trading, sir?
Well, I mean, I went to school in Chicago. I went to UIC, which was just like maybe a mile from the Board of Trade and the SIBO.
Yeah, right down the street here. Yeah.
Yeah. And I used to like literally on my breaks walk over there with my briefcase.
Yes. Old school briefcase.
Yeah, I had my look was a briefcase and a biker jacket. I'm going to have to rethink that one if I ever go back in time. But I would go to the Board of Trade and SIBO, and I would just go up to the visitors gallery because they were open then. I would just kind of sit and watch, and I don't know, that really kind of hooked me, just fantasizing about what it would be like, and not really knowing that was an option at the time. I mean, I thought that maybe that was just for some rich guy whose, father gave him a job in $1 million account and said, go trade it, which is sometimes the case, but not usually. So I guess that set of experiences, just seeing it in action and really kind of connecting with it as an onlooker.
Yeah, shame. You can't really do that much anymore. I guess you can go to the new SIBO floor. I haven't been down there myself. I was just at the SIBO a couple weeks ago, but I wasn't down on the floor. It just seems too bright and cheerful, Dan. It seems like a nice, happy place where people actually want to be. And that just doesn't seem like a trading floor to me. It's got to be dank and oppressive, right?
Yeah.
That is a true trading floor out there. Let's go out to the live again. Frank 1209 has got a question for you, Dan. He wants to know, does Dan trade a lot of 0-day? And what's his preferred strategy in that environment? Dan, you and I have obviously chatted about 0-day in the past, but Frank wants to know specifically, what are you up to, if anything, out there in 0-day? Do you have a preferred methodology for using in that 1-day environment, sir?
Yeah. I do trade 0 days on a fairly regular basis. And the main thing that I do is, I just latched on to Russell Rhodes' technique of using vol Q to trade an iron condor in the NASDAQ on a certain day when it meets certain criteria. It would probably take a little bit too much time for what we're doing here, and kind of would help if we had a visual aid. But yeah, I mean, that's basically the main play that I do with 0-day. Yeah.
All right, and let's go out here to Mr. Edwards. I like his thought process here. He says, isn't there anyone at a bank who understands Roe and could maybe have purchased a few puts to protect against this type of financial disaster? Do any of the stress tests call for that? Well, not to my knowledge. They should. In fact, we have some people on here on the network who say, like in Basel III and other reporting, the stuff the bank has on their balance sheet in terms of long-term treasuries, those are zero risk assets. They don't qualify as risk at all. So it does seem like we need to probably restructure some of these stress tests for what they view as risky, because clearly in this environment, that's what's wiping out a lot of these banks, right? That's the catalyst that then sparks the run on the assets, and then we all know what happens from there. But yes, it would be nice if some folks looked at their balance sheet and said, hey, we have a lot of interest rate risk here. Perhaps we should look into a procedure for hedging that. And that should probably be something that the banks look at going forward. Obviously, there's a cost to that. It's not free, but if you prevent this sort of run on your bank, then the cost is worth it. Mr. Dan, we have to say from Mr. Edwards, who says, can't a bank just buy a put?
Yeah, I mean, probably what they would do is they would hedge with the synthetic by, trading the put and the call. But yeah, I mean, you would think they would. And from the things that I have read, the biggest problem with these banks going under is just poor decision making by the traders and or management, or whoever the buck stops at on this stuff. It's just making bad decisions, and part of that is when interest rates were basically zero for over a decade. Somebody starts out when they're 25 and they just do the exact same thing for 10 years, and then market conditions change. They don't know what to do because they never really learned, and they should be thinking about it. But, I guess it's just complacency in a lot of cases, I guess. But yeah, you're right. You're 100% right. Somebody should have been hedging this row and interest rate risk and all that.
It always drives me crazy when these platforms have one risk, right? Like with the airlines have a whole bunch of energy risk, right? And yet they don't hedge it.
Yeah.
And then they get mad and they say, oh, the speculators are driving us out of business. It's like, well, no, maybe your own idiocy. You have one risk. Maybe you should take that off the table. But hey, who am I to judge such people? Mr. Dan, that music means we've come to the end of this episode of Options Bootcamp. But you know what? If you're enjoying the live palooza, and hey, we're having fun doing it as well, then stay tuned, listeners. We'll be back in about 20 minutes, less than that now, Bringing back the old Options Insider Radio interviews for some fun check-ins, this time with our friends over there at MIAX. They've been making a lot of moves behind the scenes, not the least of which recently acquiring Ledger X from the debacle that was the whole FTX implosion. Remember, FTX owned Ledger X, which was one of the real only approved U.S. crypto derivatives platforms to trade here in the U.S. That got caught up with all that. Well, the MIAX folks bought it. They scooped it out of the wreckage there. So it'll be interesting to see what they have planned for that. Maybe bring in some more crypto derivatives trading to the masses here in the U.S., which will be cool. Of course, they own Spikes and MJX. They have irons in a million different fires. Those guys are really moving and shaking over there. So it'll be fun to check in with them. We'll be doing that in about 18 minutes now, so that should be fun. So stay tuned for that. We'll make that free and open to everybody today as well, because why not? We're having a party. And Mr. Dancer, while the party is continuing, if folks want to continue the party over there at MTM, where should they go? What should they do?
There's nothing we like more than a party over here, Mark. Make your way on over to markettaker.com, 2 T's in a row. Second T is for Theta. You can join free. Right now we have our chat room currently for free for folks who want to join and get in on the conversation and learn from, some fellow students and participate. And we welcome you with open arms. We're here to help.
There you go. Check them out, markettaker.com. Like Dan said, the second T is for Theta. My branding invoice will be in the mail post-haste there, sir. Check them out. Any spots left for the retreat? Or is that full?
We do have a couple spots left, but we've got to get our numbers over to the hotel within like a few days, I think. So if you are interested in joining us out in California live in person for our 3-day in-person retreat, with lots and lots of, seminars that are going on, lots of classes, lots of fun, nice dinner. You want to hit me up as soon as you can, like within the next couple of days, and we can get you in.
Hit them up over there at Market Taker Mentoring, all one word, or just Dan_Passarelli on Twitter. That also works as well. It's going to do it for OBC this week. Back in a few minutes for all you cool kids listening live with Options Insider Radio. Then back again, of course, tomorrow with This Week in Futures Options and episode 2 of the Option Block. Friday volatility views, and for all you pro cats out there, easy for me to say, all you pro cats. Then, of course, Options Oddities, where we look back at the full week from an unusual activity perspective, see what the heck is lighting up our tape that you may want to trade. Always a fun and indeed can be a profitable show as well. And then back again next week, all of our usual content kicking off on Monday with the Option Block all the way through to next Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.